want to talk about how fallible we are. And I want to do so not with reference to perhaps some of the more obscure little cognitive biases we have, but to put this more in the context of a day-to-day activity where we trip up, where the fallibility of the way our brain works catches us out. Within the mentor program, we have a structured learning process. People move from one section to the next, and we have two macro or gross sections. That is a delineation between our foundation section, which is the first section that everybody does, before they move on to the advanced section. This is a clear split. It is a clear delineation between the two halves, and we have a break in between, and people's access is reset. As their access is reset on any given day, when they log into the mentor program, they will see this. It is their access to the foundation section. When they move from the foundation section to the advanced section, what they see when they log in changes to this. Now you can see there's been a change. There were 2 elements on the screen. Now there are 3. The interesting thing is that every time we do this, every time we change people's access, we get a flood of emails from people saying that they cannot see the new section, that there is something wrong with their access. Interestingly though, in each case, we've never not had a situation where, when we have logged on as them, we can see that they do have access to the advanced section, that their access level has been upgraded. Now, this is not a cognitive failing. I don't think that this is an IQ test that people fail. What I think it is a reflection of how our brain tricks us, of how intense focus is actually problematic for us. It shows in a very, very simple way how flawed and how fallible our brain is when it comes to change, when it comes to seeing what is actually happening. Consider, for example, this image. This is a static image. It is not actually moving. This is known as an autokinetic image, where the contrasting patterns of light and shade convince us that it is actually moving. But at no stage are any of the elements of this image actually moving. Our brain thinks it is. The problem we have with trading is that trading is, in many ways, a profession of perception. We take action on what we see. This creates a problem. And the problem is twofold. As I mentioned, we are flawed. Our perception is inaccurate. We often don't see what has really happened. And this problem is exacerbated by the fact that we see the world through a series of filters. And these filters are little more than an aggregation of our own biases. And in many ways, our decision-making is very, very sloppy. Because you would think that with people being logical, and in trading you need to be logical, that people would assess the evidence and then make a decision. That's not really what really happens. What really happens is people make a decision and then backfill the evidence to actually suit their preconceived notion. So we have this problem of flawed perception, intense focus failing us, and our own biases. And you would think that if people can't see a simple change in their access level for a forum, that they would struggle to trade. And the quick answer I will give to that question is yes, they will struggle to trade. Because you require clean perception to trade. You require a logical, dispassionate approach. You need to see change. And the only way you can see change is by stepping back. If we look at this image of the Dow, this image of the Dow is from the past month. It conveys some information to us, but not much. We are intensely focused on a few pieces of information. And the question is whether those few pieces of information actually convey enough to us to make a decision. I would argue that they don't. I would argue that this, in trading terms, is analogous to the problem that people have with seeing that their access level to various forums has changed. They are so intently focused on a small part of minutiae and not the big picture that they're effectively vapor-locked. They can't see what the big picture is. Yes, we can see difficulty at punching through 15,500. We can see a series of large down bars. We can see a reversal. We can see the pattern of change in volume. But it doesn't tell us enough. We're staring too hard at the pinhead. We get a better sense if we step back a bit, so that we can see the trend we've had for the year to date. We can see the move the Dow has had when it broke out from about 13,200 and tried to run towards 15,600. So we can see that trend. But even that doesn't convey enough information to us. Whilst trading is a profession of information management, you need a certain amount of information to actually make a decision. And without that information, you can't actually make a decision. If we step back a year, we start to get a sense of what is happening, and this picture enables us to put our analysis, our ideas, our perceptions into some wider frame of context. We can see these two resultant trend lines. We can see the initial breakup at the beginning of the year. We can see the acceleration and then the failure of that trend. So all of a sudden we have sufficient information presented in a relaxed manner, not staring at the screen, to enable us to formulate some sort of narrative for ourselves. We can see how these moves unfolded. We can see the break of resistance at 14,000. We can see now that we might have a banding in the market that gives us two trigger points. We can see resistance at just below 15,000, support at just below 15,000. We can see resistance at 15,400. All of a sudden the information now takes on a form that is useful. The information is conveying to us a stop-go approach for what might happen in the future. We can see prices congesting, and only cretins trade congesting price. So this more information enables us to formulate some form of trading strategy. Simply staring at price over the past month doesn't actually enable that to occur, because our focus is simply too myopic. And if we step back a little bit further, whilst too much data can be overwhelming, we can all of a sudden see this in context. We can see that markets move to new highs, so that when they move to new highs, we have no need to be concerned about this. Because whilst the journey is not linear, whilst it is not a straight line, prices don't begin bottom left and end top right. They move in a very dirty way. You can still see that within that, price and price alone gives you the information you need. So you can see the notion that when price moves to a new high, that is a good thing. And when it moves to a new high, it is telling you something very, very important. And it's something you really need to listen to. Unfortunately, most traders, when they look at price, when they look at charts, when they look at live prices, are somewhat akin to a 2-year-old watching TV. They are jammed so close to the screen that you simply can't make any coherent or cohesive decision based upon the information you're seeing. Because like a 2-year-old in front of a TV, you're not seeing the entire picture. All that's happening is your brain is being hit by what appears to be to you effectively random stimulus. Now that may be entertaining and it might be interesting, and it may also fatigue your brain, but I struggle to see how it might in any way, shape or form be profitable. So this leads us to the often quoted mantra of trade what you see. And I would suggest that that is a good mantra. I've used it myself in the past. But I think upon reflection that it needs to be expanded, that it is simply, it's one of those throwaway statements. And as a throwaway statement, it has some basis in fact, but it is not as precise nor as sharp as we would like. What we would like and what we need is a sharper statement, and one that is much more relevant to what we do. And I think this is a better statement. Trade what is real. The problem here is that you have to decide what is real, what is actual, what is true. You have to somehow manage the information you are receiving in such a manner that you remove yourself from the decision-making process and you simply see what is happening underneath. In part, this problem is solved by looking at price and price alone. But the major part of this problem is solved by simply being aware of how fallible you are, how flawed our decision-making is, how easily we are tricked, and building a model that compensates for that. Building a trading system that outsources effectively our weaknesses to the trading system so that they are taken care of. But in the end, this also presents a problem. And the problem is one of discipline. There is little point in having a model that concisely and precisely shows you what is happening with the market if you do not follow it.